1. Get disaster relief. For people living in areas prone to hurricanes, tornadoes, earthquakes, or other forms of natural disasters, the IRS periodically grants relief. With regard to 401k distributions, in effect, waiving the 10% penalty within a certain window of time. An example might be during certain severe Florida hurricane seasons. If you live in one of these areas and need to take an early 401k distribution, see if you can wait for one of these times. In addition, there are other events that constitute a hardship and therefore yield an exemption from the 10% penalty. They include economic challenges, such as job loss, the need to pay college tuition, or putting a down payment on a house. In addition, the CARES Act allows those affected by the virus outbreak a hardship distribution of up to $100,000, without the 10% penalty those younger than 59 and a half normally owe. Account owners were also allowed up to 3 years to pay the tax owed on withdrawals, instead of owing it in 1 year. They were also given the choice to repay the withdrawal to a 401k and avoid owing any tax, even if the amount exceeded the annual contribution limit. Those who were impacted by the pandemic in 2020 were eligible. 2. Use net unrealized appreciation, NUA. If you have company stock in your 401k, you may be eligible for net unrealized appreciation, NUA, treatment if the company's stock portion of your 401k is distributed to a taxable bank or brokerage account. When you do this, you still have to pay income tax on the original purchase price of the stock, but the capital gains tax on the appreciation of the stock will be lower. So instead of keeping the money in your 401k or moving it to a traditional IRA, consider moving your funds to a taxable account instead. This strategy can be rather complex, so it might be best to enlist the help of a pro. 3. Tax loss harvesting. Another strategy, called tax loss harvesting, involves selling underperforming securities in your regular investment account. The losses on the securities offset the taxes on your 401k distribution. Exercised correctly, tax loss harvesting will offset some or all of an investor's tax burden generated from a 401k distribution. However, there are limitations to this strategy that involve reducing investment losses. 4. Avoid the mandatory 20% withholding. When you take 401k distributions and have the money sent directly to you, the service provider is required to withhold 20% for federal income tax. If this is too much, if you effectively only owe, say, 15% at tax time, this means you'll have to wait until you file your taxes to get that 5% back. Instead, roll over the 401k balance to an IRA account and take your cash out of the IRA. There is no mandatory 20% federal income tax withholding on the IRA, and you can choose to pay your taxes when you file rather than upon distribution. If you borrow from your 401k and neglect to repay the loan, the amount will be taxed as if it was a cash distribution. 5. Borrow instead of withdrawing from your 401k. Some plans let you take out a loan from your 401k balance. If so, you may be able to borrow from your account, invest the funds, and create a consistent income stream that persists beyond your repayment of the loan. The IRS generally allows you to borrow up to 50% of your vested loan balance, up to $50,000, with a payback period of up to 5 years. In this case, you don't pay any taxes on this distribution, let alone a 10% penalty. Instead, you simply have to pay back this amount in at least quarterly payments over the life of the loan. Given these rules, consider this scenario. You take out a $40,000 loan over 5 years. With interest, let's say your monthly payment over the 60-month period is $900. Now imagine taking that $50,000 principal amount and purchasing a small house, apartment, or duplex in the relatively inexpensive South to rent out. Given that you would be purchasing this property without a mortgage, let's say that your net rent each month comes out to $1,100 after taxes and management fees. What you have effectively done is set up an investment vehicle that puts $200 in your pocket each month for 5 years. And after 5 years, you'll have fully paid back your $50,000 401k loan, but you'll continue to pocket your $1,100 net rent for life. You might also have the opportunity to sell that house/apartment/duplex later on at an appreciated amount in excess of inflation. Of course, a strategy like this comes with investment risk, not to mention the hassles of becoming a landlord. 6. Watch your tax bracket. Since all of your 401k distribution is based on your tax bracket at the time of distribution. A simple trick to reduce taxes is to only take distributions to the upper limit of your tax bracket. You can do detailed tax planning each year to keep your taxable income, after deductions, to a minimum. An example is if you are married filing jointly. For 2021, you can stay in the 12% tax bracket by keeping taxable income under $81,050. For 2022, you can stay in the 12% tax bracket by keeping taxable income under $82,150. By planning carefully, you can limit your 401k withdrawals so they don't push you into a higher bracket. The next one up is 22%, and then take the remainder from after-tax investments, cash savings, or Roth savings. The same goes for big-ticket expenses in retirement, such as car purchases or big vacations. Try to limit the amount you take from your 401k by perhaps taking a combination of 401k and Roth/after-tax withdrawals. 7. Keep your capital gains taxes low. Try to only take withdrawals from your 401k up to the earned income amount that will allow your long-term capital gains to be taxed at 0%. In 2021, singles with taxable income up to $40,400 and couples filing jointly with taxable income up to $80,800 can stay in the 0% capital gains threshold. Any amount over is taxed at the 15% tax rate. 8. Roll over old 401ks. Remember, you don't have to take distributions on your 401k funds at your current employer if you're still working. However, if you have 401ks with previous employers or traditional IRA, you would be required to take RMD from those accounts. To avoid this requirement, roll your old 401ks and traditional IRA into your current 401k before the year you turn 72. There are some exceptions to this rule, but if you can take advantage of this technique, you can further defer taxable income until retirement, at which point the distributions might be at a lower tax bracket if you no longer have earned income. 9. Defer taking Social Security. To keep your taxable income lower when you make a 401k withdrawal and possibly stay in a lower tax bracket, consider putting off taking your Social Security benefits. Advisably, wait until age 70 to start Social Security benefits. If retirees can afford to delay collecting Social Security benefits, they can also raise their payment by almost a third. If you were born within the years 1943–1954, for example, your full retirement age, the point at which you will get 100% of your benefits is 66. But if you delay to age 67, you'll get 108% of your age 66 benefit, and at age 70, you'll get 132%. This strategy stops yielding any extra benefit at age 70, however, and no matter what, you should still file for Medicare Part at age 65. However, do not confuse delaying Social Security benefits with the old file and suspend strategy for spouses. The government closed that loophole in 2016,